Welcome to This Explainer. Today, we're demystifying a highly specific and honestly, kind of misunderstood piece of the modern financial puzzle, the CPA comfort letter. We're going to be looking at this specifically through the lens of ignition taxes framework. We're living in an era where the way people earn a living has literally outpaced the totally antiquated, rigid models that traditional banks and lending institutions still rely on. It's like trying to fit a square peg in a round hole, right? There's this massive structural tension between our dynamic, modern income streams and the legacy algorithms of the banking world. If your income doesn't fit neatly into a standard W-2 box, well, you've likely felt this friction firsthand. You go to secure capital and bam, suddenly you hit a bureaucratic brick wall. Today, we're going to break down exactly why that wall exists, the specific risk mitigation happening on the lender side, and how this particular piece of financial verification acts as the absolute critical bridge to get your capital deployed. So, are you currently applying for a mortgage or business financing? Or maybe you're planning a major capital move in the coming quarters? If so, you already know that the days of simple handshake loans are entirely behind us. No way. Today, you're facing a mountain of strict algorithmic lender requirements. Okay, let's dive into this, because understanding the underlying mechanics of these requirements is really the very first key to unlocking your financial goals without the massive headache. Over the last decade or so, institutional risk models have become incredibly defensive. With macroeconomic shifts, regulatory changes, and ever-evolving credit algorithms, lenders are hypersensitive to anything that even slightly looks like volatility. They want predictability. When your financial profile introduces complexity, their automated systems immediately trigger a defensive posture. Understanding exactly what underwriters are looking for and the specific compliance language they absolutely need to see, well, that's what separates a stalled application from a successfully funded one.
Section 1. The Lender Requirement Roadblock, or Facing the Application Hurdle.
Think about the exact cause and effect pipeline of a modern financing application. Step 1. You submit your application for a mortgage or a business line of credit. The financials look strong, your business is perfectly healthy, and you're ready to move forward. Step 2. The lender's underwriting department runs your profile through their risk models and comes back with their list of contingencies. And right there, suddenly introduced into the mix, is Step 3. The strict demand for third-party verification. Let's move to and see how this builds. Because you see, this isn't just some random administrative request, it's a direct algorithmic trigger. When an underwriter sees non-traditional income, they immediately recognize that their internal models simply cannot accurately project future default risk based purely on your tax returns or bank statements alone. They need external validation. The application itself triggers the requirement, completely shifting the burden of proof. The lender is essentially demanding that a licensed, objective third party steps in to underwrite the reality of your financial situation, which legally and psychologically mitigates the bank's exposure. Section 2, defining CPA comfort letters and what this requirement actually entails. So, the crucial point is understanding the precise nature of a CPA comfort letter. Basically, this is third-party financial verification, specifically utilized to support mortgage applications, business financing, and other stringent lender requirements. But let's elevate this for a second and look at the actual mechanics. This isn't just a casual note of recommendation from a buddy or a quick email confirming you have funds. No, it is a highly scrutinized official professional verification acting as a real legal and financial bridge between you and the lending institution. What makes this so complex is the whole issue of liability. Lenders are basically asking a CPA to formally vouch for your financial health. But under strict industry regulations, like the AI CPA guidelines, CPAs are heavily restricted in what they can actually project or guarantee. A CPA literally cannot legally predict your future solvency, nor can they take on the liability of your loan. Therefore, a properly drafted comfort letter is actually a masterpiece of precision. It has to satisfy the underwriter's demand for independent assurance regarding specific factual financial elements, like, say, confirming you're self-employed or verifying your use of business funds, without violating professional standards or legally transferring the borrower's debt risk onto the accounting firm. Section 3. Who actually needs this? Let's identify the core audience. Who exactly gets hit with this specific lender requirement? Well, Ignition Tax identifies 3 distinct groups that their professionally prepared letters are designed for: self-employed individuals, business owners, and independent contractors. Now, what's really interesting about this slide is the structural theme here. Do you see it? These groups represent the massive shift in our modern economy away from traditional W-2 employment. If you fall into any of these categories, your income is dynamic. You're out there actively generating revenue, navigating write-offs, managing operational overhead, and reinvesting capital. And from a wealth-building perspective, it's incredibly efficient. But to a traditional lender trying to check highly standardized regulatory boxes, It looks like a complex web of risk. They just don't know how to categorize the ebb and flow of entrepreneurial revenue. So, you are the exact demographic that requires this professionally prepared documentation, not because your finances are weak, but because they simply need to be translated. The comfort letter translates the nuanced reality of your dynamic business operations into the verified, binary language that institutional risk departments demand.
Section 4. Securing confidence and approval through the Ignition tax solution. So how is this roadblock successfully cleared? Let's look at Ignition Tax Professional Financial Verification Services as a sort of industry case study in solving this exact problem. The foundational element here is providing accurate and compliant documentation. Look, lenders are remarkably unforgiving when it comes to compliance. They don't just want a piece of paper confirming you run a business. They absolutely demand documentation that strictly aligns with Fannie Mae, Freddie Mac, or specific commercial lending protocols. This is exactly why a borrower cannot simply draft a letter themselves or have a business partner vouch for them. It doesn't work that way. The verification literally must carry the weight of a recognized financial professional who is bound by regulatory standards. By utilizing a professional service designed specifically for self-employed and independent earners, you're making sure the documentation speaks the exact dialect the underwriter is expecting. It prevents those annoying back-and-forth delays that flat-out kill deals, ensuring that the verification submitted perfectly threads the needle between what the bank requires and what a CPA can legally provide. And this brilliantly illustrates the entire psychology behind institutional lending. Consider what this documentation actually provides to lenders: added confidence during the approval process. Let's dig just a bit deeper into the underwriter's mindset for a second. At the end of the day, an underwriter's primary job is actually not to approve your loan. Actually, scratch that. Their real primary job is to manage and mitigate institutional risk. When they look at a complex dynamic income file, they see potential exposure. But when you provide an accurate, professionally prepared CPA comfort letter, a profound psychological shift occurs. You aren't just handing them verification, you are handing them institutional confidence. The presence of a licensed CPA signature effectively transfers a perceived level of risk right off the underwriter's desk. You are actively removing their doubt and satisfying those algorithmic fail-safes. This infusion of third-party confidence is precisely what accelerates the underwriting process and carries your file across that final approval finish line. Which leaves us to ponder one final, genuinely essential question. Is your financial documentation actually ready for approval? We've explored the fundamental disconnect between the realities of modern, dynamic income and the rigid, antiquated rules of lending institutions. And honestly, that tension isn't going away anytime soon. So if a commercial lender or mortgage underwriter asked you for third-party verification today, would you have the accurate, strictly compliant documentation ready to give them that ultimate confidence? Or would your capital deployment stall out in a totally frustrating bureaucratic holding pattern? It's a critical vulnerability that every single business owner, founder, and independent contractor needs to actively assess before making their next big financial move. Because at the end of the day, preparedness is what separates a missed opportunity from a fully funded vision. Thank you so much for joining me for this explainer, and as always, keep learning.